What if I told you that while CNBC is busy talking about the usual suspects of NVDA and other stocks like Apple, there are 6 little-known stocks that are about to explode. In the next few minutes, I'll reveal these 6 stocks and the exact strategy to potentially double your money with them. I'm Valentine, and welcome back to the channel. I've been trading stocks for 4 years, and I like to summarize and simplify what I've learned from the best stock traders who have made millions in the market. So my mission is to simplify stock trading and investing for busy professionals like you. On this channel, we try to cut through the noise and focus on the moves that will move your portfolio. And of course, today I'm here to share something special with you. Right now, the market is at a crucial juncture. While most investors are fixating on the big stocks that have already moved and the same old big tech names, there are hidden opportunity in other stocks, and I've currently identified 6 stocks that seem like they're about to make a huge move. These 6 stocks look like they're about to finish their consolidation and are about to cross the line of least resistance. And this is a line where stocks start to explode and run up. So I think they're primed for a big run. The best part is that you can get in before the crowd can identify the stocks. If all things were to go wrong, you would lose very little money. The risk taking that I will show you will be very little that you won't even feel it. So there's a huge potential upside with very little risk. But of course, before we dive in, I want to let you know about my free newsletter that has been crushing it recently. Our subscribers have seen gains of 80% in HIMS that happened in just 3 weeks, 30% in Tesla that happened about 2 months ago, 15% in RCL, and of course, 150% in NVDA, which took 6 months. So if you want to stay ahead of the curve and get these latest picks before they run, make sure to sign up for the newsletter. The link is in the description. And of course, once you sign up, you'll also get a free lesson of my most profitable stock strategy, which took me 5 years to find. So today we are going to go through each of these 6 stocks in detail. And for each stock, we're going to develop a clear entry, stop, profit taking, and stop loss strategy. And by the end of this video, you'll have a complete game plan to potentially profit from these overlooked gems before the rest of the market catches on. And remember, knowledge is power in the stock market, and the more you know, the more you can potentially earn. Before we get into the stocks, I would like to tell you why I really like these stocks. The first reason why I like these stocks is that many of them are hitting all-time highs. When a stock is hitting all-time highs, that means that there are no buyers in the higher price targets that are looking to sell. Everybody is in a profit. So there are very little people who are looking to sell the stock and dump it on you. That is one thing. Another reason why I like many of the stocks that I'm going to show you today is that they are in industry moves. Many times when an industry moves, like we saw in semiconductors this year, once you get into the best or the second best stock, you're likely to make very huge gains. So this year, the semiconductor industry moved. We saw NVDA make 150% gains. So when an industry is moving, all the stocks will move. But our goal is to find the best stock in the industry so that we can make the most profits. I'm also seeing a lot of shakeouts in the stock. A shakeout in the stock market is when the big people who have huge money, they intentionally lower the price to scare out weak holders. And as soon as the stock has dropped to a price that they like, they buy up a lot of the stock and get it for themselves because the weak holders have sold the stock to them. And I'm seeing a lot of these shakeouts in the stocks. And lastly, I like many of the stocks that I'm seeing strong earnings. A company with strong earnings means it has a very strong business. Normally, it means that the economy is in the favor of the company and it's likely to make a lot of profit, so its stock price is likely to soar. The first stock we're going to look in today is in the building sector, and it's called DHI. So here on our chart, we have 2 sides. There's a weekly side of the chart. So the weekly side shows each bar represents 1 week. And on the daily side, each bar represents 1 bar. The white line is the 50-day simple moving average, and the light blue line, which you can barely see, I made it barely seeable for a reason because you don't want these indicators to distract you when you're watching the price. The light blue line is a 20-day simple moving average. Here we have earnings. Here we have the return on equity. These are just my very quick indicators that help me study a stock. Now, we can see that this industry is moving. If we come into TC2000, which I have to see industries, this green chart up here is the industry. This is a stock. So this is a residential construction industry. And every stock here is literally breaking to all-time highs. We can see GRBK is going to all-time highs. We can see DHI, PHM, MTH, TPH. There are many stocks in this sector. They're all going to move, but our goal is to find the best of the best. And DHI is looking like one of the best. First of all, it is one of the first to reach these all-time highs. Currently, I think that it has just gone through a big consolidation, as we can see here. This is a very big consolidation right here. The stock has just gone through that consolidation. It has broken out to all-time highs, which is something which I really like to see. Then we can see it has formed two contractions, 1 and 2. So it's being squeezed. And when the stock is being squeezed like this and then it jumps out, it is time to buy. And it jumped out on volume, as we can see. So in these consolidations, we can see that the volume reduces and then it jumps out on high volume. So in these consolidations, when there's a dry up in volume, that means people are not willing to sell, as you can see. And then when it jumps out, the volume is a lot. That means that there are a lot of buyers participating in the move. So this is one of my first choice. If you're getting in now, which I think is still a good time to get in, you don't want to risk your whole portfolio in this. I would say maybe just put in around 7% of your portfolio, and the risk can be about 3%. So if you put in $1,000, you can lose $30. That is the risk. So how are we going to play such a big move? Normally what happens on such stocks is that after a big consolidation like this, the stock will move up for a bit, and then it will consolidate onto the 20 EMA or the 50 EMA. So we can see here in a past example, it went through a long consolidation, consolidated to the 20 EMA. This is a good time to add. So at this point, you can multiply your position times 1.5, or you can double it once it's breaking out again. And once you've doubled your position, just look to sell once it moves 20% from that. So here, the first time to get in was about 112, for example, and then we could have doubled our position or multiplied times 1.5 to about 130 for an average of about 114, 115. That would have been our average price. And then once it moves 20% from here, we can look to sell and profit from it. And then you can see after it moved 20%, it came for one more consolidation on the 50-day moving average, and then it went through another long consolidation. That is the first stock. The second stock is PHM. You can see it's also in the same sector. That's why we are seeing it go to all-time highs. We can see what has happened in the past when the stock makes a very long consolidation, like I showed you. Makes this long consolidation here that we can see, breaks out. So you would buy here at around 46. It corrects to the 50-day moving average. And once it's correcting, you want to see it correcting for at least a month. You cannot trust anything that is less than 4 weeks. You want to see at least 4 weeks of consolidation, which is what we see here. And once it reaches the 50-day moving average, you can add again and look for it to look to sell it once it moves 30%. This one definitely did move way more than 30%. It moved 50% from this 50 EM SMA bounce. That was a good time. And we can see it happened again here. We could have added maybe like 10% of our account at 81, came consolidated. We could have added here around $100 again. And then we could have just sold maybe 20 to 30% from the consolidation. So that was a good plan. So this is something we can do again. We can see that the stock already moved 20% in less than 2 weeks. So this is one of the big rules. If a stock breaks out and moves 20% in less than 2 weeks or in less than 3 weeks, then you want to hold it for 8 weeks. Let's see, did it move? No, it didn't move 20%. Okay, so the plan for this one is that we can see that it has broken out to all-time highs. That is the first good thing. After it has broken out, what we want to see is the stock going to move 20% within less than 2 to 3 weeks. If it moves less than 20% in less than 2 to 3 weeks, then you want to hold it for around 8 weeks and see how it reacts. That's what I was telling you before. So if it moves 20% in less than 2 to 3 weeks, hold it, wait for it to come back to the 50-day moving average or the 20-day moving average, wait for a 4-week consolidation, which is what is likely to happen. It will go, consolidate. You wait here, then you can multiply your position times 1.5, or you can just double it. Or if you don't want, you don't have to increase your position. And then see how it reacts after that consolidation, because it's likely to go up. If the stock does not move 20% in 2 weeks, then you can just sell it once it does a 20% move. So that is one idea on how to handle this stock when you're investing it. Of course, for the risk for this stock, it's the same as the other one because you can see they have very similar patterns. We can do around 3% risk, 4% risk. So if you put in $1,000, you're likely to lose $40. Why is MHO a good stock? So we can see that MHO has gone through a very long consolidation. Once you see such consolidations, you just know that this stock is primed to move for quite a while. This consolidation was from December to July. That is over 8 months. That's a very long consolidation. The stock already moved 20%. Once it broke out, it moved 20% in less than 2 weeks. This is my first pick in the construction business. So these are the stocks that are moving. MHO is the first pick because we can see that it has moved 20% in less than 2 weeks. It has come back to the 50-day moving average. It has consolidated. And now it looks like it's trying to jump out again. So here what you would do is if you get your $1,000, the risk would be about 4 to 5%. So you're likely to lose $40. Once it jumps out here and goes to all-time highs, we can put an alert there. Then you can wait for it and see how it reacts. If it's moving 20% in less than 3 weeks, we wait for it to come back to the 50-day moving average, and then we can add again. If it doesn't do that, then we can just sell it at 20% if it takes more than 3 weeks to do. So that is the plan for this one. And the next stocks that are ready to be watched but are not quite ready to be bought are in the engineering and construction business. So the engineering and construction business is very closely related to these building stocks. That's why I think that these building stocks, once they start moving, they're going to trigger the engineering and construction to move too. So the first stock that I really like there is FIX, which is called FIX. So we can see FIX already had a huge move earlier this year. As you can see in these annotations here, we can see on the weekly chart, FIX already had a good move. The earnings are perfect. Whenever you see revenue of year over year increasing about 15% for the last 4 quarters consecutively, that is great. If you see earnings per share growth about 50% for the last 4 quarters, that is very fantastic. The goal is normally just to have 30%. But this stock is literally rocking it. It had 65, 68, and 93. So that means not only is it growing year over year very highly, it's also accelerating. 3 quarters ago, it grew at 65% year over year. But now it's growing at 93% year over year. So not only is it growing, it's also growing faster and faster. This is a recipe for a stock to make a huge move. What we're trying to do is wait for the stock to break out to all-time highs. So it did break out recently, and it faked me out. I remember I took a small position. So now what you have to do is wait for it to break out to all-time highs again. So this one is a play where you're going to be patient and you're going to have to watch it. Once it breaks out to all-time highs, has it moved 20% in less than 3 weeks? If yes, you want to hold it until it comes back to the 50-day moving average, and then you can add to your position later, right? So these are things to think about. So right now, this one is a wait for it to break out, and then you can maybe risk about 7%, 5%. And if it moves, you're in profit. If it fails, then you're going to lose very little of your account. Then the last pick that I like is called EME is even better than FIX. The reason I like this one is that we are seeing something called a shakeout. So a shakeout in the stock market is when you can see the stock is respecting this 330% price range. But then we can see that somebody came and forced the price under 330. So whenever you see this price being forced down below like this, and then the stock recovers very quickly, those are normally big buyers trying to get into the stock. They push the price down, and then as soon as people are scared and they sell their shares to them, then they just buy a lot of the stock. And that's literally what happened here. Just like the other one, we are waiting for it to break out to all-time high. So once it reaches about $400, you should be triggered to buy this stock. Of course, put in like around 10% of your portfolio. I would say this one, you can just do maybe a 5% risk. And then if it moves 20% in less than 3 weeks, you know what to do. You hold it until it comes back to the 50-day moving average. If it takes more than 3 weeks to do the 20%, then of course you just sell it 20%. It's as easy as that. So these are the stocks which you're looking to invest in. And the last stock that you really want to know. Now, this stock has been setting up for a long time. In the stock market, if you want to be a good investor, you have to be patient. So the great investors will watch a stock for months and months or even years, waiting for it to hit the perfect timing. This stock hit the perfect timing. Let's look. And this is Uber. Uber is looking fantastic. The first thing that we can like about Uber is that the earnings are perfect. You can see an average of 15% year over year. It's a $1 billion company. The revenue is in billions. Earnings per share is growing at 100%, hundreds percent per quarter. And remember, All we need is 30% over the last 4 quarters. This one is averaging 100%. This one had a negative 3 or 2. Actually, I wouldn't count it that much because the government fined it billions of dollars. So that quarter, it didn't have a lot of revenue because it was fined. So the revenue was affected. But in terms of the business model itself, Uber's business model is still looking great. And we can see a great consolidation, a very long consolidation. And this stock is likely to be going for a huge move. I would say a move that's maybe like a 70% move. I don't know how far it's likely to go, but it is looking like it's going for a huge move. So what's the game plan here? So we can see the earnings are great. So that's the first tick. If we draw a trend line here, we can see that Uber is breaking over the trend line. So right now, I would wait for Uber. You can take a small position right now, maybe around 5% of the portfolio, and your stop loss would be around $70. The time when you're going to know if Uber is really breaking out is if it reaches around $75, because we can see a horizontal resistance here that's forming, right? So there's a horizontal resistance there that the stock might fail. But we can see a lot of volume on this candle here, which is a very good sign. So right now, I would say that I would put in about 5% on my account. That's what I'm going to do on Monday. And then once it crosses above 80%, okay, then I need to have about 10% of my account in this stock. The stop would be around $70. We don't want to see this stock falling back to $70. It should just continue straight up. Okay, so after it does that, then we have to watch it again for this resistance here. I don't think it's really going to be a big issue, but that could also be a potential failing spot. Then we see if the stock is going to be moving 20% in 3 weeks or less. And also we can see Uber is going to all-time highs if we look at the weekly chart. All-time highs is always a great thing because once the stock goes to all-time highs, there are no angry buyers waiting to dump the stock on you, right? So you always want a stock that is going to all-time highs. It's going into new territory, new prices. These prices have never been seen before. And that means that people are also not looking to sell. The stock is just likely to move. It's all positive news. Earnings are great. The chart is setting up. So as soon as it breaks out here from about $75, I think that would be a very good long-term play. See if it does a 20% in less than 3 weeks, like it did here. So you see this last move here. It's a good study. So we can see that the stock did move, let's see, 70%, 20%. It did it in 16 days. And the 3 weeks is 21 days. So it took 16 days to do 20%. So that means that we had to hold it for 8 weeks. So once it came back to the 50-day moving average, this was the time to add. So here you can either double if you're very aggressive, or you can just multiply your position times 1.5. Depends on how the market overall is looking. So here you would have added, and then you could have sold once it moved again here, maybe like the 20% as we saw. So that means that your average pricing could have been 52. Then you would have gotten around 54% return on your money. So let's say you put in $10,000 here at 48, you doubled it at 57, your average would be around $52. And then you have a 50% return on $20,000. That would be $10,000 profit. Very easy. And that can happen we saw how long this took. 100 days, that's about 3 months. So that's generally how this plays goes. And after the stock goes up like that, then you can either sell it there or you can wait for it to form a third base. So here, those who waited for this one to form a third base, we can see that it failed. But even if you sold here, you aren't going to sell at a loss. You're still going to sell at a profit of about 40%, of your $20,000. While if you had sold at the top, you're going to sell around 50 to 60%. So the difference was not really that huge. Because once the stock falls below the 50-day moving average, it's clearly a sell. Please can subscribe to the channel if you like such content, and also don't forget to sign up for the newsletter that we spoke about. Thank you.